What is break-even point? The simple answer to this question is that break-even point is where the total revenue of a business is equal to the total costs of the business. In other words, where net profit is equal to zero. Break-even analysis can be performed in a manufacturing, wholesale, or retail business. In this module, the focus is on a manufacturing business. Break-even point is reached in a manufacturing business at the particular production level, in units, where the total costs are equal to the total revenue. This is expressed by the following formula. Total revenue is equal to total costs. In order to derive the formula for break-even point, the formula total revenue is equal to total costs must be further broken down. How is total revenue calculated? Total revenue is the selling price per unit multiplied by the number of units produced and sold. How is total costs calculated? Total costs are total fixed costs plus total variable costs. Total costs include manufacturing, selling, and administrative costs. In order to understand total costs, a quick revision of fixed costs and variable costs is necessary. Total fixed costs are constant. In other words, they remain the same regardless of how many units are produced and sold. As production increases, fixed costs per unit will decrease, as there are more units to divide total fixed costs by. Variable costs can be traced directly back to the product. The variable costs per unit remain constant. The total variable costs will vary in direct proportion to production. Note, in break-even analysis, we assume units produced are equal to units sold. We are now going to expand the formula, total revenue equal to total costs, making X equal to the number of units produced and sold. Selling price per unit multiplied by X is equal to total fixed costs plus variable costs per unit multiplied by X. The break-even formula in units is derived by making X the subject of the formula. Selling price per unit multiplied by X minus variable costs multiplied by X is equal to fixed costs. X multiplied by selling price per unit minus variable costs per unit is equal to fixed costs. Therefore, X is equal to fixed costs divided by selling price per unit minus variable costs per unit. In management accounting, we call selling price per unit minus variable cost per unit the marginal income. Marginal income, also called the contribution margin, is the revenue remaining after deducting the variable costs from the revenue. The marginal income is then used to cover the fixed costs. The formula for break-even point in units is therefore total fixed costs divided by contribution margin per unit.